The Minority Market. Episode 19. Why a good company is not always a good investment. Many beginners make the critical mistake of equating a strong business with a strong investment. They see a company with excellent products, dominant market share, and a reputable brand, and assume that buying its stock guarantees success. This assumption is one of the most dangerous traps in investing. Thinking like the minority requires understanding that a good company does not automatically mean a good investment. Price, timing, risk, and valuation matter as much as the quality of the business. The first factor to consider is valuation. A strong business can be overpriced. If you pay too much for a stock, future returns are limited, no matter how strong the company is. Beginners often fall in love with brands or products and ignore valuation. They assume growth will always justify the price. The minority evaluates whether the market has already priced in the company's strengths and whether the potential reward justifies the risk of the current price. Next, timing matters. Even a good company can experience periods where the stock may decline due to market cycles, macroeconomic factors, or industry-specific challenges. Investing without considering the broader context can lead to losses, despite the underlying business remaining strong. The minority recognizes that patience and strategic entry points are crucial. They wait for opportunities where price and value align, rather than chasing quality at any cost. Risk is another critical factor. Every investment carries risk, and even the best companies are not immune. Competition, regulation, management changes, or unforeseen events can negatively impact stock performance. Beginners often underestimate these risks because they are enamored by the company's reputation. The minority evaluates risk in relation to potential return, ensuring survival even if the investment does not go as planned. Liquidity and market behavior also matter. A company can be fundamentally strong, but may have limited liquidity or volatile trading patterns that make entering or exiting positions challenging. The minority assesses these practical factors before committing capital, while the majority often ignores them and faces unexpected losses or stress. Another reason a good company may not be a good investment is capital allocation and strategic choices. A company may excel in operations but make poor decisions regarding debt, acquisitions, or reinvestment. These decisions can erode shareholder value over time, despite operational excellence. Observing management behavior, decision-making patterns, and long-term strategy is essential to evaluating investment quality. Behavioral mistakes also play a role. Investors often fall for confirmation bias, seeking information that validates their admiration for a company. They ignore warning signs, market signals, or valuation concerns. The minority actively questions assumptions, seeks contrary evidence, and remains disciplined in decision-making. Growth expectations create another trap. High-quality companies are often assumed to grow indefinitely. Beginners extrapolate past performance into the future without considering saturation, competition, or industry shifts. The minority tempers enthusiasm with realism, understanding that even strong businesses face limits in market expansion, pricing power, and scalability. Understanding the difference between business quality and investment quality is essential. A great company may be a terrible investment if the price is too high, the timing is poor, or risks are underestimated. Conversely, a mediocre business can be a great investment if it is undervalued, has manageable risks, and is purchased at the right price. The minority evaluates these dimensions carefully, instead of relying on superficial metrics. Market psychology also amplifies the gap between good companies and good investments. Popular companies attract attention, hype, and momentum investing. Beginners often chase these trends, buying at peaks and selling during corrections. The minority recognizes that following the crowd rarely leads to long-term advantage and waits for opportunities where market sentiment underestimates true value. Another overlooked factor is compounding potential. A company with stable, moderate growth may deliver better long-term investment results than a high-flying star with unsustainable growth. The minority prioritizes opportunities where cash flow, reinvestment, and risk control create compounding advantage over time, rather than short-term excitement. Finally, diversification is critical. Investing in a single good company exposes you to company-specific risks. Even if the business is excellent, unforeseen events can lead to losses. The minority manages exposure, balances positions, and mitigates risks to survive and thrive over multiple market cycles. In practice, before investing, always separate admiration from evaluation. Ask, is the price justified? Are risks manageable? Is timing favorable? Will this investment survive downturns? Can it compound wealth responsibly over time? By answering these questions, you build the framework for minority thinking. The key lesson is simple. Good companies are not automatically good investments. Understanding this distinction requires discipline, patience, critical thinking, and awareness of market realities. Beginners often fail because they ignore this principle and let emotion drive decisions. The minority succeeds by combining business quality with valuation, risk management, and strategic timing. By internalizing this lesson, you stop chasing brands or hype and start thinking about opportunity, survival, and advantage. Investment decisions become deliberate rather than emotional, methodical rather than impulsive, and rational rather than reactive. This is how the minority consistently outperforms the majority, even in uncertain markets.